All right, we can get started. So, thank you to everyone who's taken time out of their lunch break today to join live. Today, we're going to be covering how Cement Australia tackled Scope 3 under AASBS 2. And I'm sure everyone that's joined is keen to hear a little bit more about this topic. Scope 3 is a challenging one, especially for Group 1s having to do it for the first time. And Cement Australia, one of our clients, has had to do it as a calendar year reporter and get started. So, what we're going to be covering today is specifically number one, what were Cement Australia's Scope 3 challenges going into the process? Number two, how did Cement Australia actually begin tackling Scope 3? Of course, it's not a done and dusted deal yet. There's a ongoing process to that, but in the first year, it's probably simpler than you think it is. Number three, of course, how do they select a solution and why did they select a solution rather than just sticking with spreadsheets? We're going to go over then a quick Avani demo and how Scope 3 emissions are implemented in Avani. And that'll show you a bit of a practical walkthrough of a similar process that we implemented with Cement Australia. It, of course, won't be live data, but it'll be dummy data. And then at the end, lessons learned, and we'll have some time for Q&A as well. Just a bit of housekeeping for those that are attending. Of course, the session's recorded and all registrants will receive the recording, so even the ones that haven't joined. You can submit questions anytime via the Q&A panel, and then at the end, during Q&A is when we'll get around to as many of them as possible. And we'll be live for about 60 minutes today. In terms of our speakers, of course, there's myself. I'm the co-founder and co-CEO of Avani, with sustainability compliance software firm based here in Sydney, and we work with Group Ones, Group Twos, particularly on the finance function and sustainability teams across Australia. And joining us from Cement Australia today, we've got Sean. So originally on the registration page, you may have seen we had Richard, but unfortunately, Richard had to step out of the webinar today. But we've got Sean, who's been working actively on Richard's team on this problem. So, Sean, I'll let you introduce yourself.
Hi, everyone. Thanks for having us, Misha. So yeah, Sean Hilton. So I work with Richard as a sustainability and environment advisor at Cement Australia. So that's a lot of covering off on our emissions reporting and other environmental compliance reporting, as well as sort of on the ground compliance from an audit point of view as well. So keen to get stuck into it today.
Awesome. I'll let you intro Cement Australia a little bit, Sean, and tell the audience a bit about the organization.
Yeah, so Cement Australia, this slide sort of summarizes it pretty well. We are the leading supplier of cement and cementitious products, so that might be supplementary cementitious products as well in Australia. We're a 50-50 joint venture owned by Holcim and Heidelberg Materials Australia. And our head office is based in Darra, Queensland, but we have sites all across Australia, both manufacturing, distribution, and other offices. We've got over 1,000 employees nationally. And then from a sustainability point of view, we get wrapped up in most of the sustainability reporting requirements from an emissions point of view. So I've been doing NGERS for since its inception in the early 2000s. And obviously, we're a Group 1 reporting member under ASRS, which has been a fun learning curve. And then we've got other reporting requirements to our shareholders and then also internal decarbonisation reporting and things like that as well. But from a Scope 3 perspective, yeah, ASRS is, like many people, has really pushed us along to get 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 kicked into gear for Scope 3.
Awesome. Cool. Keen to get stuck into the content, Sean. So, we'll talk about a few of your challenges that we worked through in detail. So, maybe starting with the first one, which I think, like what the audience needs to know is that this is a super fundamental one. You would have had to do it for Scope 1 and 2. And for scope three, it's even more important because of how many categories there are. So defining the boundary, you guys have obviously a fairly complex structure. You have two reporting entities that you need to kind of consider. And so when you first had to figure out where your scope three boundary should sit, what were the kind of key challenges or roadblocks and questions that you ran into?
Yeah, so definitely not a simple task, but from the two reporting entities from an emissions point of view, that's always been for scope one and two. But with ASRS, our only one of those entities is actually needing to report for scope three. So that we realized pretty quick once we understood the ASRS compliance requirements that there was going to be two potentially two different scope three boundaries.
Mm,
So there's the ASRS reporting entity, and then if we wanted to do scope three from a consolidated Cement Australia point of view. So we sat down initially trying to work out what the best approach would be, realizing there might be some interaction with some of the categories from a downstream perspective. And we realized that what we need to do, because scope three is such a big effort, well, it's a big effort, but it's just such a huge job. And with speaking with Nisha, yourself, and David, working out that we should just maybe strip it back, focus on the compliance first, and then know that a majority or all of our upstream emissions will still be captured
mm,
from a consolidated point of view. And then there may be some smaller data points from a consolidated point of view from downstream that we can capture next year or the year after, but we know will still meet compliance from an ASRS point of view. So it's a step by step process from that perspective. But it's not wasn't easy to come to that decision, but we decided we needed to take some steps rather than not take any steps at all.
yeah, yeah. And when it comes to what the auditors expect, I mean, as we know, scope three is kind of deferred into the second year. And it's really important that if you've kind of chosen a category to either include or exclude, you've got a good justification for it. But one of the difficult things about deciding what to include or exclude is, well, if you actually include something, are you going to have sufficient data for it? Which kind of goes into this second question, right? When you're calculating scope three emissions, did you have kind of questions or anxieties about what level of detail are you actually expected to go to when you're collecting data for the categories that are within the boundary?
Yeah, definitely. Again, it was at the same time of trying to work out the boundary. We were thinking, do we reach out to all of our suppliers from the get go and try and get primary activity data and get as accurate as possible? But we realized pretty quick that that would have just been too much to begin
Mm,
with. And I think when we were having a conversation with you, you sort of mentioned, let's just start off with the basics and just do a general ledger analysis and then
yeah.
work from there. And that definitely helped us under sort of, it gave us a little bit of relief to think, okay, well, at least we'll have a foundation, and the general ledger analysis provides that. And then from there, we then conducted relevancy tests in
Mm,
accordance with the GHG protocol. And then in our minds, we knew primary data sources that would have a high impact on our emissions side of things and from singular suppliers. But it really helps to have that general ledger to back that up as
mhm.
well. And then we can focus on going for our major suppliers or focusing on one category. And we know that it will be a systematic process for probably the rest of the time we report scope three, because it's such a large part of emissions reporting. It's always going to be an evolving beast.
Yeah, did you expect that you would be able to? Because I think a lot of people, when they look at a general ledger analysis for Scope 3, especially for finance teams, it can feel a bit, or it feels intuitive to use it, but I think there's some confusion often when you're first introduced to the concept of spend-based calculations and how exactly can you report emissions just off of spend. Like, did you guys also have that question?
Yeah, maybe not as much from my point of view because I'm not from a finance background, but
Yeah.
definitely we've been working internally with our finance team as well. And
Mm.
there are always questions saying, how does that work? But it's just understanding that the emissions factors being applied, um, uh, you're trusting that those emissions factors are based on more rigid science and averages and things like that. So
Yeah.
it was just good to know that we can do spend, but
Mm.
we know it's not perfect, but it'll still be comparative to when we get our activity data, and then the activity data is
Mm.
just going to be a lot more accurate. But the comparison between
Mm.
spend and activity should sort of even out as well.
Yeah, and I think what's important for people to understand is that uh, an auditor cares more that you've got a complete picture of your Scope 3 emissions than something that's as accurate as possible in the first year. Because you can have the most accurate calculation for some Scope 3 categories that you've included, but if you're missing entire sections of your general ledger or entire sections of your operations, then that's going to be a bigger concern. The magnitude and that completeness is what the auditors are going to look for. That's
Yeah,
why that's why we always find that the general ledger is a great starting point because the general ledger will reconcile back to your financial statements, and it's something that the auditors are already looking at. So having that
yeah,
as the baseline is going to give them that confidence
yeah,
that it's complete. And then, of course, how do you layer on top of that more detailed activity data for the most material categories? Because materiality is the second thing, is one of the other things that they're going to look at. Okay, you've got one category that is based on spend, but it's the most material. How do you improve the activity data on top of that? And you're kind of flying blind if you don't have that. You're kind of flying blind if you just start from the activity data at the beginning and don't look at your general ledger.
yeah,
Uh, I think multiple reporting obligations, you mentioned this at the start, right? That you guys essentially report to everything that there is to report to. ASRS, ENGA, safeguard mechanism. You've also got board and parent level reporting,
yeah,
uh, and to your joint venture holdings. So they all draw on the same data, and they all draw on the same data in different formats and periods. So when Scope 3 under ASRS got added on top of that, like what did that feel like? Did it just feel like one more report, or was it a little more complex than that?
yeah, definitely more complex. It was probably, oh God, was the initial thought. um, and a big part of it was resourcing because it's just the size of scope three, which is just the thought of it just makes you go, oh wow, how are we going to do this?
Mm,
So working out how we can sort of absorb that additional reporting requirement with our current resources now and then going forward as well. And it's even not even from a technical point of view, but even from an administrative point of view. So, say, keeping up to date with emissions factors. I know with
mm,
scope 1 and 2, we might have a dozen or 2 dozen different emissions factors that we've got to check every year. Scope 3, you might have, I don't know, a couple of hundred.
yep.
So that in itself is just maybe a day or two of admin that you just don't want to have when you've
Mm,
got to deal with the technical side of things. So that was a big part of what was the thought process behind it all.
mm,
And then also it really spurred on the conversation. Well, how do we make it that ASRS and Scope 3 specifically, how do we make it a resilient reporting system and how do we work it into what we're doing currently as well? And then so that's where we settled on the fact moving towards a software system where everything could be housed in the one spot, and a lot of the information, the traceability, the version control is in that platform. But then on the outside, we've still got our policies and procedures from an internal point of view that feed into that system as well. So, and then from a data point of view as well, it was a matter of re-looking at the data that we're using, and
Mm,
obviously a lot of the data that we're using is for scope 1 and 2, but that also needed to go into Avani. So
mm,
re-looking at that data and going, okay, how are we going to use this one data point and assign it to many different custom fields, I guess they call it in Avani,
mm,
but different data points for the different reports. So it
mm,
was essentially going back to basics from our whole reporting point of view, and
mm.
then building it from the ground up to make sure it's resilient in the future.
Yeah, and speaking of looking at what you're already doing and reviewing that, I think one of the comments that you made to us is that the data that was required for Scope 3 mostly already existed, but it was just scattered and it was being used for other purposes that weren't related to sustainability reporting. Um,
Mm.
what did that look like? Like, where did you actually go looking in the first instance, and what were the frustrations that you may have run into during that process?
Yeah, so working with our finance team, we realized, and a few of our data people, we realized that everything was pretty much housed in our ERP, our enterprise resource planning platform. So, but everything was being pulled from a scope 1 and 2 emissions point of view, pulled from all these different reports from within the ERP. So it felt like they were getting pulled from different systems almost.
Mm,
And so having to go through that process, and it surprised me quite a lot as well that everything was essentially in there. And then from a scope 3 point of view, we're able to pull our financial information from there as well. So
mm,
everything is kind of there from a scope 3 foundational level, obviously not all the categories. But then there was also with waste, we sort of found that
mm,
potentially because it's quite a high impact area from an environmental point of view and it's highly regulated, the data that big waste contract providers provide their customers, we've found is really, really high quality.
mm,
So something like that was a really low hanging fruit from an activity data point of view we could use, and then work it into the format that we needed to then put into category 5. So
yeah,
finding those activity data points, it was kind of a nice win, to be honest. Rather
mm,
than just using spend base, we go, oh, we actually do have this real data, and it's nice to sort of
mm,
get those small wins. But definitely, I think the ongoing frustration, I think for everyone and for us, will be getting activity data from your suppliers because we're all in the same boat. It's wanting to share information, but also wanting to understanding that some information might you might not want to be sharing,
yeah,
and confidentiality and all that sort of stuff. And then also not a lot of suppliers will have that data in the format you need. So trying to be flexible with what they've got and trying to come to a solution. So it'll be a slow process going step by step, supplier by supplier.
mm. Yeah, but to your point, waste is a good win, and in particular, the Greenhouse Gas Protocol, it allows you to use spend as an estimate for quite a lot of categories. Waste is one of them where it's not, and that's because, to your point, the emissions associated with waste don't necessarily correlate very closely at all with how much you're spending
Mm.
on it. And
Yeah.
so, and there's different ways in which waste can be treated, recycled or landfill, that are very big variables in how it gets treated. So it was interesting to work with you guys through different categories and understand where did you already have activity data available. And we find that with other clients we work with too, that often they're surprised by how much information they can get that they're either already collecting for other purposes, just operational efficiency tracking, but also what you can get from your suppliers, your key suppliers, if you just ask them, because they like even from the same supplier might be providing you in like just information in the form of invoices, for example, and then you have to go
Mm.
in and pull the data off the invoices. But maybe it's worth sometimes just asking them, can you provide this to us in an Excel format, something that's a little cleaner and easier to process? Uh, and we find that often they can. You just need to ask. They won't tell you proactively.
Yeah.
All right, cool. So let's talk about, of course, I mean, you've already spoken about this a little bit, why you ended up looking for a solution rather than continuing to work on this on spreadsheets, and then, of course, why you ended up partnering with us. But let's start with the first one. Like, why not spreadsheets? Like, what was it about the manual handling that worried you specifically? I'll kind of keep that open because there can be a lot of things.
Yeah, so the two key concerns was audit risk and key person or human error risk. So we wanted to move away from any sort of system that would allow human error, or if there's someone who leaves the company or moves to a different position, then that reporting to then break down and then having to build it up from scratch again. So it's just trying to create that resilience in the system. And then from an audit risk, having a system that sort of houses all the workflows and the transparency, change logs, and anything else that we need to show our working. So that were the two key considerations for us because, again, scope three is just a behemoth compared to scope one and two. So the resourcing required by keeping on a spreadsheet just would have been too onerous, well, from our perspective.
Got it. And what so what was on your lists ultimately then when you were actually evaluating solutions, right? You had the key problems that you wanted to solve. You must have had in mind what you thought a solution could look like. And so what was on that list and what ultimately tipped it in Avani's favor?
Yeah, so I guess on that slide there, our four key items was regulatory alignment, audit ready, scalable, and platform usability. So they were four key requirements for getting a emissions inventory, and Avani did tick all those boxes. Regulatory alignment and being audit ready was huge for us because it just reduced again the need for additional resourcing, or unnecessary or not unnecessary resourcing, but yeah, too having to scale up too much. And then another huge pro that we sort of looked at was the flexibility offered with Avani as well. So in terms of other products that we did look on the market, they might have been from larger companies or larger providers, but the systems that they had might have been a little bit more rigid, and the customer support wasn't didn't seem to be there like what we were expecting with Avani and that we've received with Avani, and that's really helped us along with the journey, particularly with Scope Three as well, because everyone's kind of learning along the way. So it's really helped with that flexibility point of view from a system and the platform usability as well, because we don't want just the emissions nerds in the company to be using the platform. We want other people. Sorry to call you an emissions nerd, but
Of course.
yeah. So we just
I'll
wanted
wear that.
we wanted other people within the company who aren't in the emissions space to be able to get a log on to Avani, and they might not have the same permissions as I do or Richard does, but we want them to be able to use it and chop and change the data or create some spreadsheet or create some graphs or graphics that they can then present to their business unit, and then they can just check with us if they really wanted to as well. So it's that allowing it to be used across the business, not just for five people or something like that.
Awesome. Yeah, it's great to hear all that. I think going back to your why solution list, the human error and audit risk, and in specific, the key person risk is definitely one which we're seeing across quite a lot of companies. There's a lot of Group 1 organizations that will have sustainability specialists, of course, and that's as a result of having the resourcing to have that. But in Cement Australia's case, you've been reporting to ENGA for many years now, and so you've already built up a little bit of a capability. Whereas a key person risk, another organization might have never done this before. So they're doing ASRS for the first time. So, it lands on the finance team, maybe the financial controller, or maybe even health, safety, and environment takes it on, or an investor relations person. And the key person risk can become even more acute there because if they build that knowledge up and then, of course, win the lotto or move on to a different opportunity, then all that knowledge leaves with them. So it's always important to have a central place that where if someone new has to come in, they can pick it up, or the uh, the responsibility can be shared with yourself, even if you've got like a different role that's not sustainability.
Yeah, definitely.
So let's get into the how and a little more practicality here. So let's go back to actually defining the scope 3 boundary. So can you walk us through how, like the steps you followed to actually get to a defensible answer on the boundary? And, what's the kind of heuristic or process you followed to decide whether a specific category was in or out?
Yeah. So leaning on, I think sort of the slide sort of alludes to it a little bit, is we did lean on the GHG protocol because that's what AASBS2 sort of relies on from a metrics point of view. So after doing the initial general ledger analysis based off our internal understanding of our boundary, then we set about doing a formal organizational and operational boundary assessment. So that's going through each organization, working out, and from an operational control point of view, working out if operational control was held from an emissions point of view. And then also, once we sort of set that boundary out, where it all sits from a ASRS compliance point of view, so that one reporting entity, and then going down to a relevancy test for each of those categories, and the relevancy test there saying size, influence, risk, stakeholders, outsourcing, and sector guidance.
Mm.
Um, and then relying on those going yes, no, yes, no, yes, no. And then if any of those came up with a yes, then we include it. And then just going through and finding out where the best data points are currently, and then working out where we want to be next year and the year after and going forward.
Yeah, super important to do that because there's 15 scope 3 categories. If you
Mhm.
start trying to immediately chase activity data for every single one of them,
Yeah,
that's exactly when you're going to get into a rabbit hole that is hard to dig out of, and it's all going to start feeling pretty overwhelming.
yeah. And with cement, there's some categories that from sector guidance aren't relevant, but from a maybe from a or if you're not aware of it, then you might go, okay, how are we going to chase this information
Mm.
up, or what are we going to do? But you just got to make sure you're reading these documents and understanding these documents and these guidance that are provided, because they are very, very helpful.
Yeah, cool. And then, we've spoken about how we started with the general ledger and the financial statement. So what would you say to the audience, like if someone were to ask you, why should you begin from the general ledger, and not just start chasing activity data in your experience?
It gets the monkey off your back. So you just go, thank God we've got something.
Yeah.
So that was the huge relief from doing general ledger data. And it just gives you something to work off. And I think, as I mentioned previously, it then it then allows you to identify high emissions and high impact categories, and then high impact activities as well, or suppliers. And because you're not, and with ASRS, because there's those transitional relief implementation of the standard, we know we sort of have a few years to improve the system. And again, with the greenhouse gas protocol, it's our understanding that scope 3 is always evolving, and it's never going to be fixed like with scope 1 and 2. So there's always this expectation that there's always going to be improvements year on year from a data point of view. So we
Mm.
know that we don't have to have activity 100% this year or next year. But we just need to be showing our working and our systems that we have in place for how we're going to improve it year on year.
Yeah, yeah. And in this first year, you're going to start with that general ledger. And as I mentioned before, right, what an auditor might look at is say, okay, the estimated materiality of these particular categories based on spend are quite high in comparison to the others. Uh, do you have, and what ASRS says is that you should use the most detailed available activity data to you without undue cost or effort. I'm
Yeah.
sure there's a lot of people looking at what that actually means and what they can get away with, and it's fair enough. Uh, but for you, where do you expect that activity data is? We've spoken about waste, right? But where do you expect activity data is going to make the biggest difference for Cement Australia in comparison to what spend would estimate?
Yeah, I think for us it'll be our transport emissions. So that's both upstream and downstream. Um, Again, with our initial ASRS or our confirmed Scope 3 boundary with ASRS, there'll be a little bit of interaction for downstream transportation. So we actually have activity data for that. But the upstream activity data, working with our main suppliers there, because they're we're pretty confident that we'll be able to get pretty accurate information there, and it'll make a huge difference compared to the spend data. So that's probably our main focus from an activity data point of view.
Yeah, there's a lot of things that can affect whether your upstream transport, what your upstream transport costs, and it does not
Yes.
necessarily, and it's not just the distance that has been traveled and the fuel that's been burned.
No, exactly. There's a lot more to it.
Yeah. And for anyone that's in the audience, Sean said that they'll have activity data available for downstream transport and distribution. I think Cement Australia may be the only one in all of Australia that will have that luxury because of your corporate structure. Uh,
Yeah.
because an interesting clarification there in terms of categorization is. Uh, Almost inevitably, every client that we speak to believes that upstream transport and distribution means any transport that is to your facilities, and then downstream is any transport that happens after it leaves your facilities and goes to a customer. Unfortunately, it's not that simple. Anything that you pay for is upstream, even if you pay for delivery to your customers. So I think in your case, Sean, of course, it is downstream because Cement Australia's entity doesn't pay for it, but a different entity pays for it, but you have access to the data because of the nature of your corporate structure. Is that right?
Yeah, essentially between our two reporting structures, just the
Mm.
way they're set up and with transport and things like that. So that just means that we've got activity data already there and available,
Yeah.
which definitely helps. But that's something we know we'll have to work on from a consolidated group point of view, because that then we have to get a downstream boundary. So that's
Yeah.
something that might be good now, but we know it's going to be a thing we got to work on next year.
Yeah, yeah, exactly. Uh, okay, documentation. This is a really important topic, right? It's all well and good to have numbers that are defensible, but then auditors are going to expect you to document all of the assumptions, all of the limitations of your methodology, how emissions factors have been applied. So, how are you thinking about how you're going to put together and maintain that documentation?
Yeah, well, the good thing with Savani is that we can do it in there, and including any assumptions that we have as well. So that's our going to be our main port of call with documenting methodology and assumptions, and then it's sort of all in one place. And then we've got traceability year on year as we do an assessment for each calendar year that we go through as well. So that's kind of what we're relying on mostly from that point of view.
Awesome. And with those assessments, so one of the key things that, of course, was a goal with putting a platform in place is that you end up doing the same thing consistently year on year. And of course, the effort can go down over time. So, how do you expect that your job next year, for Scope 3 is going to be easier than this first year that we've done it?
Well, yeah, from a the automation point of view, and then also with the assistance in terms of rules that we've applied, say across the general ledger in this instance, and saying the cost description has these key words in it, and then apply this rule being an emissions factor gets applied to it. So knowing that that can just get rolled over for the next year, and that is it takes a little bit of time to initially set it up, which you would expect, but then knowing that that's set up for next year, and then you just have to do a bit of Q&A on it, or we might come to a conclusion that a few things need to change. But
Mm.
yeah, it's that initial setup, and then knowing that we don't have to do that next year to that extent is really good to know, and it
Awesome.
automatically assigns for next year as well, which is awesome.
Yeah, yeah, awesome. Well, what I'm going to do now is give a bit of a practical demonstration of what you just described, Sean, for those that are on the call. So I'm going to quickly switch over to Avani here. And what I'm going to walk you through is essentially how do we take that initial setup approach for Scope 3, starting with the financial statements and the financial data. And we find that this is particularly useful, especially if we're working with like directly with the finance team or in collaboration with the finance team, because the good thing is all of this data is really easily accessible and exportable from your ERP system. So what we've got here in Avani is a section where you upload your chart of accounts, and then what an auditor is going to expect is your chart of accounts reconciles to, of course, the five different account types, your assets, liabilities, equity, revenue, and expenses. And that then will reconcile up to your financial statements. And they'll expect that you've either made a call to include or exclude each account, and if you've included it, what category is it going to go to? That's that boundary setting process and relevance testing to help you understand where should each one of these, like essentially what Scope 3 categories are going to be relevant and which ones can we leave behind and not worry about. So you can see here, if I scroll down to the expenses section, AI has done a first pass to categorize each one of these, as well as write a auditor justification, which can then be overridden. So for example, IT hardware goes to capital goods, which is Scope 3 Category 2. Telephone and internet goes to Scope 3 Category 1. You've got domestic flights that goes to business travel. So each account on the chart of accounts has an either in or out decision, and an auditor can go through and say, okay, I'm comfortable that the assessment of each of the accounts that appears in your financial statements is complete, and therefore you haven't accidentally left out potentially a material account that's going to be relevant for your emissions reporting. That then flows into the completeness check as well. So why this is important is, when you take the data out of your financial system or your ERP system, there's always a risk that you're taking out potentially the wrong data for the wrong time period, or maybe you're taking out data that includes transactions that haven't been posted and therefore wouldn't appear on your financial statements. And you don't want those ending up in your emissions report because then you don't have consistency or completeness between the two. So you upload your opening and closing trial balances to Avani for the financial year that you're assessing, and then compare the movements of the debits and credits on the general ledger to the movement on the trial balances. And that's your comparison to see, okay, if those are equal, if the opening balance plus the balance on the GL equals the closing, I know that I've got a matched balance there, and therefore uh, the general ledger transactions I'm looking at are actually what match my financial statement. So an auditor can look at that and say, okay, I'm confident that you're using the right transactions from the right period, and that these movements match what's on your financial statements too. Tick. So with that categorization complete, you've always already got these two completeness checks. that's when we get to, Sean, what you were talking about, which is the actual general ledger. And how do you then, across these different categories, assign the emission factors in a way that will stay consistent year on year, and also that, of course, isn't a manual process that you just have to go each row in Excel and look at different descriptions. Because I guess a challenge that we always come across, right? Every company will have for their specific operations a chart of accounts that has very detailed accounts for their operations. But then they might have every finance team has an account where they just chuck all the transactions where they don't know where else to code them, right? Miscellaneous expenses, for example. And that you can't cleanly categorize into scope three. That's when you have to go down to the transaction level and actually start looking at the keywords in the description. Does this mention, for example, Uber ride to the airport or train ride for a client meeting? And that might just end up in a miscellaneous expenses bucket, for example. Uh, I think you can imagine doing that manually would be super difficult. And so, what we do on the general ledger is we actually look at the specific keywords and how those keywords actually categorize what the transaction is and therefore which emissions factor it should go to. And so we do that here in the ledger analysis by using AI to analyze both the description and the account level and actually suggest rules for us to apply to the general ledger. An auditor can then see those rules, see the justification behind how they were applied, and the first draft is kind of done for you. You can go in and adjust the draft, of course. There's always that human in the loop to verify it, but at least you don't need to then be sitting there looking at what are the different keywords in the transactions that I need to find so that this ultimately ends up in the right emissions bucket. So I guess Sean, it'd be good maybe to just get your kind of thoughts on how this process was applied to Cement Australia and, what your experience was like with this in particular.
Yeah, it definitely felt like it saved a lot of time. And then even, yeah, applying those rules. Yeah, I think it's saved an enormous amount of time because I remember going through it. Would have been a few months ago now, and it didn't take as much as I thought it was going to take. But it was just finding those key words, like maybe with like freight or something like that. It was represented as FRGT. And so
Mm,
there were so many different types of freight. And so I was able to sort of identify that and say FRGT equals category four or something like that.
mhm.
And then it just cuts out a huge chunk of manual workload there. So it's nice to know that I also won't have to do that next year.
Yeah. Yeah, I guess that kind of example is shown here, right? You have an account name that's called office rent and outgoings,
Mm,
and those invoices might have recharge lines for parking fees on them, but the recharge lines might say something like car or car park. And so
mm,
by picking that up in the description, where if the account name is office rent and outgoings and the description contains keyword car, then you know that it should go to category six, business travel. The factor should be set to parking services. An auditor can then go in and look at, okay, every rule covers a certain set or a certain subsection of the GL and uses deterministic logic that we can follow and recreate, right? You're not using AI to always assign these because then you can't go into an auditor and say and answer the question, how did you get this done by saying, oh, the AI did it. The AI needs to draft it, but then you have to implement that rule, and then the auditor can clearly go through and follow that logic and see what was it actually applied to. We've got the coefficient. This is for parking services. I can see which database it came from, and so they can then get comfort that uh, what you've actually applied is accurate. And there's also, again, complete coverage of the general ledger. So that gives you the full view of your scope three upstream, at least, before you start going to activity data. Of course, once you actually begin moving on to activity data, that might end up being on different forms of invoices, supplier reports, for example. So how do you then end up augmenting that or enriching the general ledger data that's underlying it? So then, switching over here, and I believe this is something that we're actively working on now with your team, Sean, but actual invoice processing. Uh, we've sat on calls with auditors where, they are specifically looking for how can we trace each number back to the source document, the source document often being invoices and PDFs. And by having to, of course, extract that information manually, put it in a spreadsheet before you upload it, you still end up with that question in front of an auditor. So we get those invoices in, Avani reads the consumption and the spend directly off those invoices that then get reconciled and grouped up into the different scope 1 and 2 and scope 3 categories. And most importantly, because we take the spend off those invoices, that ends up being something that you can match back to the general ledger as well. So that's important. It's a step that people often skip, even for scope 1 and 2, but especially when you get to scope 3, you need to also be looking at what is the spend on these invoices that I'm pulling the activity data off of. Because if you don't do that, then how do you know that that's on your general ledger represented, you've also got an invoice form? That's another question that auditors are going to look for, is how do you prove that completeness again against the financial statements? But yeah, this is something we've kicked off with you guys. So I think that how I guess it would be worth asking how you've handled this to date.
Yeah, so to date, well, currently in the process of doing this upload, but to date, from a scope 1 and 2 point of view, we have been using invoices, but it's
Mm.
obviously been a manual process. So it'll be good to then move that into sort of reading through the program. So then it takes away that manual process of having to put it all in the spreadsheet and then sense check it. Because what we did would essentially be sense checking invoices against information that's in our ERP,
Mm.
whereas we can just upload those PDFs and then it's sense checking with information in Avani, which is essentially our ERP data. So yeah, it's just streamlining the process.
Yeah, awesome. Okay, so hopefully that gave everyone a bit of a practical overview of how we've helped Cement Australia implement some of the things that Sean's been talking about. Before we get on to Q&A, I'm going to, if I can get behind the Zoom tab, go back to the slides, and we will finish off with some observations from the process. So, question for you, Sean. Surprises. Looking back, what surprised you the most with this process? Was it the data itself, or was it the compliance side of things, or was it something else entirely?
Definitely the data. It being all, well, not all, but a lot of it being in one place, definitely surprised me. And I'm not necessarily I'm not from a finance background, or even a data analyst background. So that was a huge surprise for me. But it was also quite comforting to know that you're just looking at the one platform, even though it's extremely complex, it's all there and you just got to ask the right people and dig and then sort of build it out.
Mm. Yeah, yeah. Awesome. And finally, the framework differences. That's a really interesting one with you because you've got such a complex reporting structure. Did you have any thoughts about how that kind of created some unique challenges for you that maybe some others in the audience have also got, and how you know, anything that you learned from that?
Yeah, well, obviously our ASRS to other reporting differences might be more unique to us, but I think from a framework point of view, what we always wanted to go back to was really understand what's being required from the different reporting requirements. So start from a compliance point of view and then build from there. And then also leaning on, so for ASRS exactly, especially, is leaning on the greenhouse gas protocol and the guidance there as well. So really understand, read these documents, get a good understanding, even if you're not the person that's has final accountability or final responsibility for it. It just helps with providing information that will be relevant, and helping work as a team as well. So I think that's probably um, the thing that helped the most, because it helped me understand sort of how I want and needed the data to be represented, or what data is needed, or processes that needed to happen.
Mhm. I think one of the most interesting things about your multi-reporting framework challenge was that you actually have some data that ends up under one framework going into scope one and under the other
Yeah,
going into scope three.
yeah, very, very, very unique, and actually beneficial, from an beginning point of view for Scope 3. But definitely, it's yeah, a unique situation for us, I think.
Awesome. Alrighty. We have had a few questions come through, so I'll quickly open up the Q&A. Um, So, first one, we are using spend data, which unfortunately includes GST. Is it feasible to put a calculation in, i.e., remove 1/11th to bring back to actual spend? The good news is that that's not technically necessary. There's a lot of emission factor databases out there that have two versions, and I believe the one that's most popularly used in Australia also has this, but it essentially accounts for the fact that a lot of the spend is going to have GST in it. So but even if that's not the case, Avani actually does have functionality to allow you to split off a percentage of the spend so that part of it goes to no emissions factor and part of it goes to actual creating emissions. So that would technically be possible, but thankfully not actually necessary. Um, Sean, did you guys have that challenge or run into it? I don't remember whether we even spoke about it.
Um, yeah, I can't remember either, and I know at that point in time, it was sort of working more closely with the finance team, because I
Mm.
didn't, yeah, not being an accountant or from a finance background, the whole chart of accounts and going through that process, I didn't wasn't as closely involved. So yeah, um, can't really remember.
Yeah, yeah. One to ask your team.
Yeah.
Uh, what sort of resourcing, headcount, hours was involved with defining the boundaries, and was this done with or before involvement by Avani? Maybe you can answer this one, Sean.
Yeah, from headcount and hours, not as many people, or not as many hours as you'd think. To put a number on it, I'm not too sure, to be honest, but I was definitely surprised. And then we did do it, because we've been reporting on scope 1 and 2 for so long. We sort of had an idea of our boundaries, so that I think might have helped quite a lot as well.
Mm.
But we did have quite a lot of involvement with Avani, from the boundary setting point of view as well, with helping us along, or if we had questions, working with David and Connie and Misha and the team to get that. But yeah, actual numbers, yeah, I wouldn't really want to put any numbers on there. Sorry.
The well, there's a few steps to boundary setting, right? There's of course the operational or well,
Mm.
organizational first, then operational, and then of course scope three has its own boundary setting policy for
Yeah,
you to decide whether things are included or excluded. And I think you referenced that in on one of our earlier slides. Yeah.
yeah, yeah, yeah.
Uh, okay, this one's for you. Do you plan to use activity data 100% of the time in the future for Scope 3 emissions, or will this be a combination of activity and spend data?
Definitely a combination, and yeah, we're pretty happy with that, because again, going back to the GHG protocol, there's never the expectation that it's going to be 100% activity data, because that's just unrealistic. But there's definitely a need to have a plan in place from our perspective and from looking at the GHG protocol to have a plan to continually refine to move away from spend data. So, I mean, in a perfect world, maybe in 10 years' time, we'll have 100% activity data, but even then, I'd be surprised if that was the case.
I would be even more surprised than you would be, Sean, if that was the case. Uh, cool. Approximately how long did it take from starting with Avani to develop your first reliable Scope 3 emissions estimate? Weeks slash months.
Um, I would say probably around 3 months. But then even once we got that estimate, it's been a continual work in progress.
Mm,
So yeah, I'd say around 3 months, but that wasn't necessarily intensive resourcing as well.
mm,
Because we knew that we were starting quite early on from the ASRS point of view, we weren't worried about doing an intensive program to get it up and running. And we just wanted to take our time to get it right and just methodically go through the process. So I imagine if you wanted to do it in weeks, it's definitely possible as well. It's just how much resourcing you want to put into it.
mm, mm. Awesome. Do you think accounts payable, AP, automation tools will help with ESG reporting, assuming these tools can read supplier invoices to collect the required information? Uh, I guess it probably depends on which AP automation tools you're looking at. Uh, but we don't want it to depend. I think that's why we've built that invoice processing functionality that I was demoing at the end is for the specific use case of handling the extraction of activity data from different supplier invoices. So definitely one, I guess whoever asked that question, if you want to reach out to us and we can show you an example based on maybe some of the invoices that you've got, uh, more than happy to give it a test run. Thank you, everyone, for, I think we're finishing right on time. So thanks, everyone, for joining for your lunch break. Appreciate everyone that's joined live and, of course, those that have watched this through to the end in the recording. And yeah, looking forward to the next one. And thank you so much, Sean, for your time and contribution to this as well.
No worries. Thanks for having me.
Have a good day, everybody. See ya.